Hey everybody, Serge Berger here from the Steady Wealth Podcast. Thank you for joining us for another episode of the Steady Wealth Podcast at this very critical juncture. And before we actually talk about today's topic, which the question I'm going to propose, or the question I'm going to pose actually, is whether the age for stocks or the age of stocks is over, or at least over for now. Before we look at that, I want to quickly go back to last week's episode where I was going a little bit deeper into our Q4 fourth quarter playbook for 2023, where we're talking about sort of those opposing forces of the economic gravity, the slowing of the US economy, the global economy for that matter, and what is going to win out the tug of war between that and the potential for stocks to rally into year end from a seasonal perspective. And we got a whole bunch of questions on it by email, so I thought I would just quickly bring that up again as a follow-up. And what we are seeing at this typically at this juncture in the economic cycle, where we have peaked out, we're heading towards a slowdown. I would argue it's almost impossible to avoid a recession due to interest rates, which we're going to cover here in just a minute. But I just wanted to reiterate that typically at this point in the cycle, while it's possible to get rallies in the equity market in the fourth quarter, which is very different from saying that the equity market at some point is going to bottom in October and rally for the rest of the year. But typically at this point in the cycle, the economic gravity is going to win out that game, which would mean that, yes, we could get rallies in the market, but they're probably going to be limited. So that's our base case. Now, of course, we reserve the right to change that view, but we do think that where rates are and we have a panic attack in the interest rate market, and that is now spilling over very visibly, very clearly. You can literally feel it in the market into more panicky kind of behavior. The consumer slowing down. We talked about the student debt repayments, student loan repayments have started up again this past week. A lot of things together, including, of course, the shock of interest rates that's now coming together. So again, quick reference to last week's episode. And we do think that while, again, we could get some rallies in the equity market, they would probably be limited to the extent that we are in a slowing economic environment at this point here in the fourth quarter, which is basically means we want to respect both sides. And that's where we're going to be very tactical, very sort of careful buying dips for trades and keep them at that, as opposed to thinking we're in a new bull market. I think we're at the very end of the cycle of the economic expansion, as opposed to at the beginning of a new cycle, which is, I think, important to note at this point. But what I talk about today a little bit more, with a bit more focus on the bond market once again. And I just want to bring up the point and pose the question, as I said before, whether the age for stocks is over. If we look at periods of time back in history where we had essentially a low interest rate environment, you tend to see things get crazier and crazier in terms of what people do for returns. Risk aversion's out the window, and a lot of that's because there's free money. And number one, and number two, because they have to go out and take out a lot of risk. So if you think about, let's think back to 2020, when rates came crashing down, everyone was given free money basically. And I'm talking about particularly the US economy and to some extent in Europe and some other parts of the world as well. But people were literally given free money. Rates came down, so speculation became rampant. Things like Dogecoin and some other things like that come to mind. This is not an anti-crypto comment, by the way. It's just that's a very risky type of environment. And I think in hindsight, that should be clear to a lot of people. The volatility is certainly significant. So you have people being pushed into risky assets, because they get money is free, but also because they have to take risk to make money. Meaning interest rates, treasuries yielded more or less nothing at that point. And they actually were very low for now a decade. And I think we've had a regime change, which gets me back to what I mentioned before. I think we're having a panic attack here in the bond market. And that panic attack, I'm willing to say, and I talk to our subscribers and listeners and clients, both on the research side, but also at Blue Marlin Advisor, bluemarlinadvisor.com, Blue Marlin Advisors. is our investment advisory firm. I talked to them about it as well in terms of what that means from allocation wise, how we need to change things. We have been changing a lot of stuff over the past year and a half for clients' portfolios. And that's actually what I would like to talk about. So let's go through a couple of things here. I still see a lot of people not understanding the regime change we have, or at least maybe not willing to understand it just yet. But that's why I'm doing everything we can, both through the public forums here, but also, of course, to our clients directly. So first of all, why would people start allocating more to the bond market? And again, all I'm doing here is addressing the question whether we have seen the end of the age for stocks for now. Remember this, I'm not saying that this does not mean, I should say, that one shouldn't buy a single stock and the stock market's all poison. No, of course not. But the age for stocks typically tends to end or come to a extended pause. By the way, the stock market's sideways for 2 years now. Okay, keep that in mind. So it's already taking place and being proven that it's taking place. But typically, when we get to this point in the cycle where rates, again, I've showed this over and over again over the past 12 months in this podcast, when rates go from 0 to 5, things will change. It just takes time. So I would like everyone to think about, what does that mean for your portfolio? Remember, I'm not allowed to give financial advisor in the public forum, but I want you to think about, what does this mean for your portfolio? So first of all, let's talk about what typically drives people into the bond market. And then we can maybe go back and check the boxes and see if the current environment looks, smells, and feels anything like that. And then you'll see the similarities. First of all, let's talk about people would prefer bonds. Why? Typically speaking, a few things come into place. Risk aversion. Investors prioritize capital preservation, meaning they're becoming more risk averse. So bonds are typically preferred in that environment because the fixed interest payments and lower volatility on average, now I'm not talking about high yield bonds, are typically more in check than in the equity market. And I think, again, slowly but surely people are coming to that realization. Income, right? For the first time in a long time, our baby boomer generation and other generations younger are getting yield, are getting money. From a risk-free rate perspective, what's the risk-free rate? Well, the industry standard risk-free rate is the 3-month U.S. Treasury bill. So investors seeking a steady stream of income will favor bonds. In that environment, they typically provide more regular interest payments, making them suitable for, again, retirees or just in generally people looking for cash flow. That could be a company. It could be someone looking to supplement their income from a job. Market uncertainty, again, as I think we're heading deeper towards a recession. Maybe we are in a recession. During such periods of economic uncertainty, people tend to flock more to bonds. Now, obviously, the treasury market's still in a one-way road to the downside, but we've seen inflows, actually, net inflows. It's just that there's a lot of supply coming in, but at some point that supply gets soaked up, and then the bond market can catch its footing. But typically speaking, when people are scared, they tend to put more stuff into bonds. Not any kind of bond, but here we're talking about, I'm mostly talking about the U.S. Treasury market here for the time being. So bonds can be seen safer than equities. Fixed income payments offer more predictability, right? So the predictability of returns is there compared to potentially more fluctuation of stocks. Now, what makes this particularly dangerous at this point and tricky is we're coming out of a massive age of stocks. The age for stocks has now lasted way too long, in my humble opinion. It's now probably, we'll go back to 2020 when it more or less continued. So I'm going to say we've been in an age of stocks for 25, 30 years. If you look at it through the lens of the crazy bubbles we've seen and how the unwillingness of the governments to let the debt bubble kind of deflate in that sense, that's another topic for another time. But diversification is another thing. I think a lot of people we're talking to more and more realizing that diversification is important. The average typical investor we talk to still has way too much concentration in equities, and basically U.S. equities, which just basically means you're invested in tech stocks from an index perspective, right? From a broad sort of S&P 500 centric view. So diversification is a great reason for people to go more into bonds, reduces overall risks. And bonds can act as a stabilizing force in mixed asset portfolios. Now, of course, the past year and a half have not been that. To be very clear, that's more of an anomaly than the rule. But I would argue at some point yields get so attractive here around 5.5%. risk-free, right, quote unquote, that is an interesting alternative to equities. Tax advantages, some fixed income instruments offer tax advantages. The predictability of returns is there. And when valuations get out of whack in the equity market, which I think they are, and you have a lot of historical concentration in risk right now. The top 10 stocks in the S&P 500 still make up 30% from a market cap perspective. Typically, it's closer to 15, 20%. So we're still way over our skis in terms of that. So again, that's important. Liquidity needs, some investors that need access to funds, so they're being in stuff that's very liquid, treasuries. That's more a smaller reason for the average investor at home. But I know we've got plenty of investment advisors and professional investors listening to this as well. So that may be something more for you to be focusing on as well. The way to think about this, in my view, at this point is really how much risk do I have to take? And this is not the first time I'm talking about this here in the Steady Wealth podcast episodes. I've talked about this over and over again. And I'm trying to give you all the different potential angles of how to look at this. But I really would like to get people to think about, what does it take for you to make, if that's your goal, to make, let's say, 8, 9, 10% per year in a portfolio. With interest rates having gone from 0 to 5, 5.5 plus, we can now make let's call it 3/4 of that return almost risk-free. So we only have to take a little bit of risk, like 2-3%, to actually make that full, whatever it is, 7, 8, 9% that we're seeking to, if that's one. I'm just giving a hypothetical example of someone's return goals. And I think 9%, 7, 8, 9% per year coming out of the age of equities, by the way. So people are going to have to start thinking about what's more normalized return. What's not normalized, what's not a normal return, is what we've seen for the past 12 years. When rates are very low, couldn't do anything wrong, rates keep going lower, bond prices kept going higher, and the equity market kept going higher because you have a lower discount rate. Basic DCF model math, right? But that age is over. As far as we're concerned, that age is over. Yes, rates can normalize and go back lower at some point and find some midpoint, but I don't think that. I think the age of 0 rates is over. It's almost inconceivable to go back to that sort of type of era. Of course, anything can happen in life. I don't want to totally discount it, but I think there's an extremely low likelihood that we're going to go back to that anytime soon. So we're in a higher rate environment. People have to start thinking about lower returns. So what's not normal is 15% return of the S&P 500 per year, which we had now from 2010 on up. That's not normal. We've been talking about this here at the Steady Trader and at Blue Marlin Advisors as well to our clients for northward of 2 years now, 3 years. That's not sustainable, and it's now happening. The good news, the great news, is that we can make a lot of money with a lot less risk than we ever had to take, at least not looking back. Let's call it 15 years, okay? And the exact year doesn't matter there. So let me just give you a couple of visualizations on this. Again, if you're watching this on YouTube, you'll see a couple of charts. If you're listening to traditional channels, YouTube channels, you will just hear me explain these. Doesn't matter one bit if you are going to not see this chart. I'm going to explain them just as well. But just to give you a little bit of perspective, I'm going to quickly share the chart here. 1 second. We're going to be looking at this thing here. Perfect. Okay. So what I'm going to show you here is just, first of all, let's start with the yield curve. I think that's an important part here. We've been talking about the yield curve now for a year and a half. A lot of people toss that around. That's something that's become more of a cocktail hour conversation, but it's important. And first of all, I'd like to point out, just going back to equities first. If you look at the yield curve and you want to look at I'm showing a chart here of the yield curve. That's a yield differential between, let's say, 10-year notes and 2-year treasuries, right? So we peaked out at about a negative 1%. So the yield of the 2-year note was almost 100 basis points higher, 1%, than on the 10-year. And we've now dramatically had sort of re-steepened the yield curve, where as I'm recording this, the yield curve is only negative between 10 and 2-year notes by about 30 basis points, so 0.3%. That's why is that important? Because that is typically at this part in the cycle where the equity market starts to wake up, right? The Fed knows this. Lower equity markets, meaning a drop in the stock market, is a quite likely high likelihood here on forward through maybe a multi-quarter lens to give you a time frame around that. Interesting is the corporate bond market has not really given us the spike in yield that we would like to see. So yields on corporate credit, so that was called the credit spread, or you can look at it as the option adjusted spread. So the spread of bonds, of corporate bonds, yield that's required for an investor, that an investor requires to take on more risk than buying an equal maturity, let's say treasury note, treasury bond, whatever, treasury, yeah. It's been going up, but it's not like it's spiking through the roof. So that's something that we're still watching very closely for it to come to fruition. But if you look at just the global yields here, and what I'm showing here is, again, the increase in interest rates over the course of obviously the past couple of years, year and a half, but how that stacks up even on a 10-year look back. And what you can see here, and what I'm describing, and I think what's so important here is the fact that, again, we can get a dramatically higher rate with a lot less risk. So the question is, and this is the question of the podcast, the point of today's episode, is the age for equities over? And I'm going to make I'm going to make it clear, put this, that our view is that, yes, the age for equity is over. Now, does that mean that you have to go out there and call your investment advisor, if you, hopefully you have one, right, and tell them that you have to sell every single stock and liquidate everything? No, that's not the point. Again, this is not investment advice, but it just means that the equity allocation not only may have to come down, but gets to come down. That's a good thing, because you get to make a lot more money with a risk-free rate, basically, right? So again, I think a lot of people still haven't fully gotten their head around that, and they're still hoping that their equity portfolio, their Teslas and a few other growth stocks, are going to make them rich and overcome any other problems in the world that they have financially. And I think that's an extremely dangerous view to have at this point. So I think the equity market, just purely mathematically, forget anyone's views, forget any talking head like myself here spewing all sorts of opinions, or at least research, I should say. Just mathematically, if you have a higher discount rate, so if the interest rates go from 0 to 5%, we're going to have to discount the future cash flows of a company down much harder. So the net present value of the future cash flows is lower. And that means that the stock price is lower. So I think we're slowly starting to get to the point. By the way, the average stock in the S&P 500 so far here in 2023 and heading into the fourth quarter now is actually down for the year. Okay, so just think about that. And of course, they were down last year. So that gets us back to the other discussion of the massive over concentration on those the Magnificent Seven, the top 10 stocks, that kind of thing, which I think is the next thing to mean revert. So yes, I think the equity allocation here is, for most investors, way too high. And the bond market is here to say something very clearly, which is that there's a lot of opportunity, particularly, and again, particularly talk about the treasury market. That does not mean that I expect the treasury market, the bond market, in terms of price, to start rocketing higher tomorrow. It just means that I think the yields are getting very juicy. Even if yields go a bit higher, we would still get the coupons. I would encourage everyone here listening to this to have a conversation with your investment advisor about that. If you don't have one, we're more happy to talk to you about it at bluemarlinadvisor.com. Have a conversation with us. If you are a self-directed investor, I just want to make sure that you find some sort of a partner to talk about, to do things. The period of easy money, the period of stocks going up and bonds going up, so the age of the stock market, I think, is over. It's been over for a couple of years now. We're on the record. I made a big deal about this more than 2 years ago at this point, that I think equity returns are going to be flat to down maybe over the course of that 5 to 10 year period. We're now 2 years in, and that's exactly what so far is happening. Now, again, of course, we reserve the right to change our view going forward, but I am more confident than ever at this point that we have seen the end of the sort of golden age for stocks for now. Will we have another great age for stocks at some point? I sure hope so. I just think for right now, it's over. So this is important. It's very important, regardless whether you're retired, or you're in your 30s, 40s, 50s. It doesn't really matter. It's important it's important for people's financial future. So I hope this helps folks have a great week, and we'll see you back here at the next episode of the Steady Wealth Podcast. Thanks for listening.